Hey guys, Eddie here from Dilleen Property. Today I want to do a quick video. This video is about should you pay down your mortgage on your first property or investment property you have first before you buy another investment property. So that's the question, that's the I guess the topic we're talking about today. And there's a lot of different ways to look at this, and as always, I'm not a financial advisor. This is just from my experience with building my own property portfolio. My thoughts behind this is there's different scenarios. Say for example, with my own situation, I bought my first property when I was just after I turned 19 years old. The property settled, I bought my first investment property. After that, I was very young at the time, still young, but much younger then. I thought, like everyone else thinks, I wanted to continue buying property and building my portfolio, but I thought, I bought an investment property, I have debt against it, debt's bad, I should get rid of it. So for the next year or two, I just put all the extra money I had into the mortgage. I tried to pay it down as quickly as possible. And looking back, that's probably one of the biggest mistakes that I did. The reason why I say that is because building a property portfolio, say if you want to, everyone wants to build, if you're looking to build a property portfolio, there's a reason behind it. You want to reach financial freedom, you want to set yourself up for retirement, whatever the scenario is for yourself. For me, is I wanted to create wealth over time. I wanted to build a portfolio so that I could quit my job and do things I wanted to do and not have to be annoyed and pissed off going to work for someone else every day. So that was my reason behind it. Paying down your first investment property has a few flaws if you're looking to grow a portfolio, that is. So the first property I bought was around 138,000, say it was 140,000, I think it was about 138,000 by memory. Almost, it's going on 8 years ago or so. I had a mortgage on it probably around 120,000, something like that by memory. And it was renting out for about 220, 230, whatever it was. So the mortgage is around 120. For a couple of years, I just tried to pay that down. So every cent, every dollar, if I was making X amount, I was just trying to pay that down. I wanted to get that down to zero as quickly as possible. What I should have been doing, and what if I was started over again and I was in the same situation, I would not be putting more money, my excess money, into the mortgage. I'd be putting it in an offset account. An offset account, which if you don't know what an offset account, check out one of the other videos or do some research, but it's basically an account where you have your savings and it's in an offset account, but you're not paying interest on the amount. So if you have an offset account, you got say 50,000 in there in your offset account, and your loan's at 120, then you'd only pay interest on 70 grand because that's offsetting that. So, but most people should know that. The reason why I wouldn't put it into the actual mortgage, because once you actually put money into a mortgage, sure, it could be in a redraw facility depending on what bank or lender you're with, but sometimes it's actually very hard to get that money back out of the mortgage. So what I would recommend doing, and this is just from my experience of course, is keeping any extra money that you have coming in every week, every month, every year. Instead of paying your mortgage down, keep it in your offset account. If you're looking to build a portfolio of 5, 10, 15 properties, you need to have accessible savings, accessible cash in the bank, ready to use. You could say, sure, I'm just going to pay this down and my loan will go from 120 to 80K or whatever it is, and this could be $1 million. This is just a scenario. I don't usually buy properties as cheap anymore. Usually they're a lot more, but it's just a scenario. You need to have savings or cash available to use for multiple purchases after that. If you do do the first scenario and you put your money and try to pay down your mortgage as much as possible, say you've got one property and that's the scenario, and you're buying a second or fourth or fifth property, whatever, and you've got all your savings or accessible cash in your mortgage, most likely when you go to a mortgage broker or lender, they're going to say, sure, you can borrow 100% of the property value. You've got equity, you can borrow 100% of the next property. The problem with that is when you borrow 100% of the next property that you're buying, you're doing what's called cross-collateralizing your properties together. And what that is, say if you've got one loan, say this scenario going back to 2010, 2011 when I was in this scenario, this is exactly what happened. You know, my loan went down to 90K or whatever it was, or 100K, and then I had 58, 60 grand, and this went up a little bit as well, but we'll just stick to very simple terms. So my loan was at 90, I wanted to buy another property for 150,000. So they said, sure, you've got equity between the value of, it was about 150, and your loan's at 90, we can lend you 150,000. So they lent me 150,000 to buy that next property, and my loan against that property was about 165,000 or whatever it was. So the property's worth 150 or a little bit more, but say 150, but my loan is 165. That's a big problem. That means you're cross-collateralizing your properties together, and that's what you do not want to do, because that can get you stuck for multiple reasons. I covered this in another video, but this is just a simple, I guess, video about paying down your mortgage. If you're looking to build or grow a portfolio, I would not be putting my excess savings into the mortgage. Say you want to get to 10 properties and you're at 1 or 2 properties, if you're putting your excess money into the loan, it's sometimes very hard to get it back out. So I'd rather put it in an offset account, keep it accessible, then you can continue buying more property. If something comes up, you've got your savings, cash available to jump on a great opportunity. So I hope this video's helped. Maybe rewatch it again if I went too fast, but there's some other videos that I put up just about having accessible cash, not cross-collateralizing your loans together. These things can get you stuck when building a portfolio, and it's very, very important. One wrong move in property investing and it can actually put you out for 5 years, 10 years, cost you hundreds of thousands of dollars if you make one silly mistake. So that's where these videos are there to just, give you as much information as possible, learn from some of the mistakes I've made, but also some of the things that's worked for me as well with building my own portfolio. So thanks for watching, guys, and I'll catch you in the next video. Bye.